In the world of finance, stability is paramount. It's the bedrock upon which we build our financial futures, ensuring that our investments can weather the storms of market volatility. It's about building a secure financial future, one that can withstand the ups and downs of the market and provide peace of mind. Bonds play a crucial role in achieving this stability. They are often seen as the backbone of a well-diversified investment portfolio, offering a reliable source of income and a buffer against market turbulence. They act as a ballast, providing a sense of calm amidst market fluctuations. When stocks are volatile, bonds can offer a steadying influence, helping to balance the overall risk in your portfolio. Imagine a rocking boat on choppy waters. Bonds act as the counterweight, keeping the vessel stable and on course. This metaphor perfectly captures the role of bonds in an investment strategy. They help to steady your investments, offering a sense of predictability. This predictability is invaluable, especially when planning for long-term financial goals like retirement or education. This stability is especially crucial as we navigate the uncertainties of life and the markets. Bonds can act as a financial compass, guiding you through turbulent times with a steady hand. Bonds are, in essence, loans that you make to governments or corporations. When you purchase a bond, you are essentially lending your money to these entities in exchange for interest payments. When you purchase a bond, you are lending money in exchange for regular interest payments and the return of your principal at maturity. This arrangement provides a predictable income stream, which can be particularly appealing in uncertain economic times. This predictable income stream is a cornerstone of a balanced portfolio. It allows investors to plan with greater confidence, knowing that they have a reliable source of income. However, like any investment, bonds come with their nuances and considerations. It's important to understand the terms of the bond, the creditworthiness of the issuer, and the interest rate environment. Understanding the different types of bonds, their risk profiles, and their behavior in various market conditions is essential for making informed investment decisions. Whether it's government bonds, corporate bonds, or municipal bonds, each type has its own set of characteristics and risks. Incorporating bonds into a diversified investment strategy can help mitigate risk and enhance returns. By balancing bonds with other asset classes like stocks and real estate, investors can create a more resilient portfolio. Consulting with a financial advisor can provide valuable insights into how bonds can fit into your overall investment strategy. Professional guidance can help you navigate the complexities of bond investing and make choices that align with your financial goals. Ultimately, the goal of investing in bonds is to achieve financial peace of mind. By providing stability, predictability, and a reliable income stream, bonds can help you build a secure financial future and navigate the uncertainties of the market with confidence. Let's break down the world of bonds into digestible pieces. Bonds are essentially loans made by investors to borrowers, typically corporate or governmental entities. When you purchase a bond, you are lending money to the issuer in exchange for periodic interest payments and the return of the bond's face value when it matures. There are three primary categories of bonds: government bonds, corporate bonds, and municipal bonds. Each of these categories serves different purposes and comes with its own set of characteristics and risks. Each type comes with its characteristics and risk profile. Understanding these differences is crucial for making informed investment decisions. Government bonds, issued by national governments, are generally considered the safest. They are backed by the full faith and credit of the issuing government, which means that the government guarantees the repayment of the bond's principal and interest. They carry the full faith and credit of the issuing government. This makes them a popular choice for conservative investors looking for a stable and secure investment. Corporate bonds, issued by companies, offer higher potential returns, but also carry higher risk. The risk level depends on the financial health of the issuing company. If the company performs well, investors can enjoy higher returns. However, if the company faces financial difficulties, the risk of default increases. Municipal bonds are issued by state and local governments to fund public projects. These projects can include building schools, highways, and other infrastructure. Municipal bonds often come with tax advantages, making them an attractive option for certain investors. When evaluating bonds, it's essential to understand key terms like yield, coupon rate, and maturity date. These terms help investors assess the potential returns and risks associated with a bond. Yield refers to the annual return an investor can expect. It is a crucial metric for comparing the profitability of different bonds. The The coupon rate is the fixed interest rate paid on the bond. It determines the periodic interest payments that the bondholder will receive. Maturity date refers to the date when the principal amount of the bond is repaid to the investor. This is an important consideration for investors who need to plan for future cash flows. By grasping these fundamental concepts, investors can begin to navigate the bond market with greater confidence. A well-rounded understanding of bonds can help investors build a diversified portfolio that balances risk and return. Remember, knowledge is power, especially when it comes to your financial well-being. The more you know about bonds and other investment vehicles, the better equipped you will be to make decisions that align with your financial goals and risk tolerance. Economic uncertainties are a fact of life. Recessions, inflation, and geopolitical events can all send shockwaves through the financial markets. During such turbulent times, bonds often act as a safe haven for investors. When the economy weakens, central banks often lower interest rates to stimulate growth. Lower interest rates make existing bonds more attractive, as they offer higher yields compared to newly issued bonds. This increased demand for existing bonds can drive up their prices, providing a buffer against losses in other asset classes. Furthermore, government bonds, particularly those issued by developed countries, are generally perceived as safe haven assets. Investors flock to these bonds during times of uncertainty, seeking stability and capital preservation. While no investment is entirely immune to market forces, bonds, particularly high-quality government bonds, have historically demonstrated resilience during economic downturns. Diversification is a fundamental principle of sound investing. It is the practice of spreading your investments across various asset classes to mitigate risk and enhance potential returns. It involves spreading your investments across different asset classes, such as stocks, bonds, and real estate, to reduce risk. By not putting all your eggs in one basket, you can protect yourself from significant losses if one particular market takes a downturn. Bonds play a crucial role in diversification by providing a counterbalance to the volatility of stocks. They are often seen as a safer investment, offering more stability and less risk compared to stocks. Stocks, while offering the potential for higher returns, are inherently more volatile than bonds. This means that their prices can fluctuate widely in a short period, which can be unsettling for investors. When the stock market experiences downturns, bonds tend to hold their value better. This is because bonds are generally less affected by economic cycles and market sentiment. This inverse relationship between stocks and bonds helps to cushion the impact of market fluctuations on your portfolio. When stocks are down, bonds can provide a buffer, helping to stabilize your overall investment. Imagine a seesaw. When one side goes up, the other goes down. This seesaw effect between stocks and bonds can help maintain a balance in your portfolio, reducing the overall risk. Bonds act as the stabilizing force, preventing your portfolio from swinging wildly. They provide a steady stream of income through interest payments, which can be particularly valuable during times of stock market volatility. By incorporating bonds into your portfolio, you are essentially creating a smoother, more predictable investment journey. This can help you stay the course during turbulent times and avoid making impulsive decisions based on short-term market movements. Remember, diversification is not about avoiding risk altogether, it's about managing risk effectively. By spreading your investments across different asset classes, you can achieve a more balanced and resilient portfolio, capable of weathering various market conditions. In conclusion, bonds play an essential role in a diversified portfolio. They provide stability, reduce volatility, and help manage risk, making them a valuable component of any long-term investment strategy. So, whether you are a seasoned investor or just starting, consider the role of bonds in your portfolio. They can be the key to achieving a well-balanced and successful investment journey. Diversification, with the inclusion of bonds, is a powerful strategy to help you reach your financial goals while minimizing risk. Embrace the art of balance and let bonds be your anchor in the ever-changing seas of the financial markets.